What's up everyone, it's Cody with MoneyVest. So in this video, I wanted to discuss exactly why the markets were higher on Friday and why the markets did rally in the past week, because we saw a pretty significant gain on Friday with the NASDAQ, S&P, and the Dow Jones all pushing higher. So there was certainly some confusion. In fact, I was watching CNBC yesterday and there were literally so many people just absolutely confused. I was like, wow, the markets are higher today. It's kind of crazy even after the very strong labor market report. So I want to break down exactly two reasons why the markets rallied the way they did. NASDAQ was up a little bit over 1.6% last week, and all the gains came on Friday. So Friday, the NASDAQ was at 1.6%. That put the week up also 1.6%, and S&P 500 was up a little bit over 0.5%. And on Friday, we were up over 1.18% as well. So hope you guys enjoy this video. I'm going to break down the unemployment numbers, and I'm also going to talk a little bit about the reason as to why we rallied, and the dual mandate from the Federal Reserve, and the different quadrants that there are within the dual mandate, and where we really want to be and where we really don't want to be within that dual mandate. So hope you guys enjoy this video and find it helpful. Again, make sure that you drop a like. That's all I'm asking in return, as you subscribe to the channel. I would really appreciate it. And links to our Discord and Patreon is going to be down below if you're interested in joining, and of course getting access to all the buy and sell alerts, options alerts, trade ideas, members only videos, Excel spreadsheets, individual stock reports. Everything is going to be included with the link down below, and we'll love to have you on board. So this right here was the unemployment report, and it came in very, very strong, right? I mean, this is one of the strongest reports we've gotten in such a long time, because the numbers in the past, I mean, we've seen 4 months in a row at sub 200,000 job gains, and the prior number got revised by, you know, a pretty substantial number at 187,000 jumping to 227,000. And for this report, I mean, it was more than double, right? The consensus was 160. We got 336,000 jobs. So on an absolute basis, you know, we might be wondering, you know, how is it possible the markets rallied so strongly after getting such a strong jobs report? Because that shows a very strong economy, and that only increases the probability for the Federal Reserve to raise interest rates, right? So 25 basis points is what they've penciled in to their summary of economic projections. Unemployment rate stays steady at 3.8%, 263,000 private payrolls, and manufacturing payrolls increasing 17,000. 62.8% participation rate, average hourly earnings up month over month and year over year at 4.2%. So everything was, you know, incredible from an economic standpoint, from a labor market standpoint. So the two reasons have been split into technical and market's expectations of the current economic situation, okay? The first reason I'm going to break down is technical. So I do strongly believe that the rally that we saw on Friday, and of course a lot of that for the entire week, was partly because of the technical rebound, okay? You know, we talked about this in one of our previous videos. In fact, I specifically mentioned word for word, what did I say? I mentioned that I'm actually surprised the markets haven't rallied yet. And I think I mentioned this on the Friday live stream. I think I mentioned it on the Thursday market update. And I was kind of confused. I was like, okay, markets are oversold. I mean, it doesn't make sense for us to keep going down here. I think we are due for a bit of a reversal, because we were really oversold, right? We talked about certain indicators. That's exactly why I did videos earlier in the week talking about I'm ready. Like, I am ready to start the process for dollar cost averaging, because markets are oversold right now. This is a very rare occurrence. We don't really see as many stocks as there were down below their 20, 50-day moving averages. S&P 500 is rarely, down over, 20% from its highs, and we were at 11, 12%. So we didn't quite get down to 20%. That's why I also mentioned like a little bit too early into the process, but I don't mind getting started. And volatility was obviously very muted the entire year in 2023, but we did see it get up to over 20 levels. So this rebound so far, the reversal on Friday and last week, and possibly kind of heading into next week when we do have inflation numbers, has primarily come from the technical side, because over 90% of S&P 500 stocks were trading below the 20 to 50-day moving averages, right? We talked about it in one of our previous videos, but this right here was the chart that I mentioned specifically. I talked about how we came down to 6%. If you come over to the daily chart, look where we bounced off of, right? This is literally where we were same time back in March, same time back in December. And what did I mention in one of my previous videos? And of course, we've been talking about this in our community as well, that you don't get that many opportunities in the markets to be buying, to be dollar cost averaging. I mentioned that, I can count in one hand how many opportunities we got in the last year where we could seriously dollar cost average. And there's only 3. Only three: October 22, December 22, March 23, and now this was the fourth one, September, October 23, right? So once again, we're back down to those same levels, and this right here was the other index we were talking about, percentage of stocks trading below their 50-day moving average. We didn't quite get down to the same level as from back in October of 22, but we did break down below the level from back in March of 23. So technicals were oversold, period. Volatility was at over 20. So if you come over to the VIX, we got up to as over 20. We haven't seen these levels since May of earlier this year. So that's exactly what we talked about in our Discord as well. So if you come over to our Discord channel, by the way, all of this analysis, everything is going to be available for you if you want to, again, take advantage of it. But this right here is, what we talked about on September 27. Pretty much mentioned it's starting to send some pretty good risk reward levels here. I will highlight some reasons. VIX up another 3% today, getting to almost 20 levels. S&P 500 stocks trading below their 20-day moving average, dropped another 45 today to 10. That means 90% of stocks were trading below their 20-day moving averages. Short term, we are very oversold. This is the 50-day moving average, which was at 13. That means 87% of stocks were trading below their moving averages. And NASDAQ is down over 10% from its recent highs and down 10% from its recent highs. Correction territory, and S&P is down 8% from its recent highs. Pretty reasonable drop. Now, that being said, the next support levels for S&P, where I do believe they will settle down at 4,200, right? This was back in September 27, so literally just a couple weeks ago. S&P 500 4,200 and NASDAQ 12,500. So if you come over to S&P and where we kind of bounce off of, you'll notice S&P came down to 4,200 to, not really to the dot, right? But it came down to as low as 4,210, right? 4,210, that's where we settled in before pushing up 2.5%. And NASDAQ here coming down to 12,000, actually 13,000. So we didn't quite get down to 12,500 as I was expecting, but we did kind of rebound a little bit sooner. And that's why I was like, I don't mind starting the process here, knowing fully the markets can drop even further lower. But, there's no point trying to time the market, but instead starting the process so that you are invested and you can take advantage of days like yesterday when the markets were up 1.6%. So the bottom line is that I think it was very much technical driven. S&P 500 was also trading at its 200 simple moving average, and big tech was also trading at, at its support, and the dollar index was also down. So that's the technical side, which I believe that over 80%, 90% of the rebound that we saw was mostly technical. Now, this right here is also another reason why I believe the markets rallied the way they did, because look, a stronger employment report reiterates the possibility of a soft landing, right? That's what it does. Because if we get inflation prints that continue to show signs of declining, meaning that they are coming down, employment numbers continue to come in strong, what does that do? That reiterates the possibility for a soft landing in the economy, right? And soft landing is exactly that. Soft landing is avoiding a recession and bringing inflation down. If the Federal Reserve can do that, then they have accomplished soft landing, which is a very, very rare occurrence for them to do during a quantitative tightening cycle. And this also, I think, is one of the reasons why the markets rally, because of macro, if you think about it, right? Federal Reserve is towards the end of their rate hiking cycle. And because of a very strong employment report and the market understanding that this is probably going to be, even if they do another 25 basis points, that's going to be the last rate hike that they're going to do, it's not going to matter, right? It's not going to make or break the economy with another 25 basis points. So for those reasons, I think the macro, once again, started to believe, or the market started to believe from a macro perspective, that soft landing is indeed a possibility. Because economy continues to be strong, labor market's super tight, and inflation is trending lower. Of course, we'll find out more about inflation next week when the numbers come out on October 12th. But this is really where that reiteration is coming from for the market, and as a result, we're seeing some very nice gains. Now, this is the dual mandate that we have talked about in our previous videos and during our live streams as well. This is where we currently are, right? So currently, 2023, that's where we are at the moment. And what you'll notice is that we're obviously high on inflation, but we're also really, really low on unemployment, right? So that's where we are at the moment. We're pretty high on inflation, but we are also low on unemployment. Unemployment is going to be on the x-axis, and core inflation is going to be on the y-axis. Now, the Fed's target obviously is moved towards the target, right? The Fed's target is literally right here. The dual mandate is going to be in the middle, which means that they are willing to expand the unemployment rate a little bit, which is why they've expected unemployment to go up to over 4.1%, while also bringing inflation down, right? So basically moving both towards the right and towards the bottom to get down to their target of 2% inflation and about just over 4% unemployment. Now, this right here is the nightmare zone. This is exactly where the Federal Reserve does not want to be. This is the last place the Federal Reserve wants to be. So we definitely want to avoid the nightmare zone with a plague. This right here is the hard landing zone where you've got, inflation down all the way here. But at the same time, we have increased on the x-axis, meaning that we have increased the unemployment rate to a point where there is a potential for a recession. So in other words, there could be a hard landing. And this is another place that the Federal Reserve does not want to be, right? They don't want to obviously see the hard landing. So I've made a point over here. The bottom half is better than the upper half, and I'll get to that in just a minute. But at the same time, the left half is better than the right half. And what that means is the ideal situation, right? The best situation for the Fed is obviously the big boom, where you've got unemployment, which is low. So that means there's more and more people employed, jobs market super tight, and inflation is really, really low, right? You've got inflation that's modest at under 2%, and that would lead to, again, interest rates being more stable and big boom, both in the economy, in the markets. Everything's going to be flourishing. People's going to be with jobs. They're going to be spending, investing, and it's going to be good times, right? So this is the big boom, and this is, the best position to be in. This is where the Federal Reserve, in an ideal world, would prefer to be. But this is, of course, the target what the Federal Reserve also has. Now, the reason why I mentioned that left half is better than the right half, which is left half over here, is because, look, I know inflation is troublesome. I know inflation's been brutal. Gas prices, grocery prices, putting a lot of strain on a lot of consumers. But I will tell you, this is still better than a full-blown recession. This is a recession zone where unemployment is higher, right? Unemployment's higher, people are losing jobs, right? What would you rather have? A stable job that pays you good, decent money with high prices that you are basically paying for groceries and gas, or not have a job in the first place, right? So obviously the former is better, right? The latter is worse. That's why I mentioned left half is better than the right half. In obviously an ideal world, we want to be as low on unemployment, as low inflation as possible, but when it comes to relative selection, left half is better than the right half. Now, also, bottom half is better than the upper half because inflation is far more difficult to deal with than unemployment, right? So that's why we want to bring inflation down, right? Because if unemployment starts to increase, the Federal Reserve has the tools to directly impact unemployment. But when it comes to inflation, it's an indirect battle because yes, they can control interest rates and they can force people to spend money versus not spend money because of cost of borrowing. But a lot of it is not in direct control for the Federal Reserve. Like inflation is very much driven by supply side as well, right? Oftentimes we see inflation being driven by the supply side, right? They can control the demand, but they can't control the supply. So that's why I mentioned bottom half is better than upper half because Federal Reserve has more control over unemployment. And if unemployment rate is, let's say, for example, higher, then they can lower the interest rates and force companies to hire more and they can bring the unemployment rate down. But they can't do that with inflation. That's why it's taken us so long to get to, where we are at 4%, down from 9% about a year ago. So it's going to still be a pretty hard challenge, pretty hard battle for the Federal Reserve to get down to where we are. So, in my opinion, we got to constantly be paying attention to what's going on from an economic standpoint, obviously. Nightmare zone is, look, all of these are possibilities, right? They're all possible outcomes like quadrant 1, 2, 3, 4. I mean, they're all possible in the realm of possibilities. 4 is where one would ideally prefer to be. This right here is the target, which is 0. 2 and 3, we don't really want to be into at all. I mean, 2, we can completely ignore it because this would be the worst case scenario for the Fed because they would be in a dilemma whether to raise rates, cut rates, what do they want to do? Hard landing is still a possibility, and that's exactly why I wanted to do this video is because right now the market's expectations have changed slightly because unemployment numbers came in so strong, and now the market's starting to reiterate that perception of a soft landing. But I want you guys to always remember that, look, this has been mostly a technical rebound. And yes, we could continue this rebound going into next week when inflation numbers come out, maybe the week after that. But eventually, I think the market needs to be aware that soft landing, as much as the consensus it is of a soft landing, there is possibility for us to still see a potential recession going into 2024, which would obviously lead to a hard landing for the economy, right? That's going to be this scenario right here where unemployment rate starts to go up, considering that interest rates are higher for longer. Even though inflation comes down, the Federal Reserve will have to switch gears and battle this high levels of unemployment, which could obviously lead to economic contraction. But that would also lead to buying opportunities and dollar cost averaging opportunities in the market. So, take it week by week, take it day by day. We'll obviously be live next week to cover the inflation numbers. And that's exactly one of the reasons why, from a technical standpoint, I did take some trades. I'm happy to close them out, for a profit, because I don't fully trust the rally that we're seeing at the moment. Even though I'm happy to participate and invest and dollar cost average and buy more, I'm not fully on board with the rally that we're seeing solely on the back of technicals, maybe a little bit of macro shifting a little bit with soft landing scenarios. So let me know your thoughts down in the comment section below. As always, if you enjoyed this video, found it helpful, make sure that you drop a like and don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below. Would love to have you on board as a MoneyVest member. And again, you get access to all the analysis, all the members only private videos, Excel spreadsheets, documents, everything's going to be included. And as always, happy investing. I'll see you all in the next video.